Hi, this is Stuart Weems and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And before we get into today's Q&A episode, I promise not to bang on about this, for the next couple of months, but I just want to remind people that if your intention is to buy my new book, Wealth by Design, pre-ordering it would be a massive help because bookstores and other online retailers more now than ever before will look at pre-sale numbers to decide whether they want to order the book. So if my followers to this podcast and, if you've enjoyed the content over time and you feel like, you're probably likely to buy the book, it would be fantastic if you'd consider pre-ordering it. The link is in the show notes. There's a pre-order bonus as well, which is a research tool that you can use that is trained exclusively on more than 500 blogs, 750,000 words. It's a lot of content out there that might help you, if you have a situation where you go, I wonder if Stuart's written about this. Well, this tool will certainly help you research that. So as I said, links in the show notes. And if you're, willing to consider pre-ordering, it'd be fantastic. I'd appreciate it a lot. Okay, enough self-promotion from me. Let's get into the first question. First question is from Josh. Josh writes, I thought it'd be good to get a question from a young listener as they're all predominantly 40 plus. I'm 28, my wife's 29. Our combined income's 220. I have 30 grand in super. She's has 110,000. I've got 98,000 in HECS debt. She's got zero. Roughly 40,000 in index-based ETFs in the US emerging markets, global, and so on. I started investing when I was 20 years old, but made some stupid decisions on smaller cap Aussie stocks and lost about $15,000, hence switched to ETFs. That's a normal learning curve there, Josh. I think a lot of people can look back in their 20s and 30s, 40s, maybe even 50s and think, okay, there was some mistakes there. But we've got to learn from our mistakes, don't we? And certainly investing in ETFs isn't necessarily sexy, but it definitely works. And, you do it for a very long period of time consistently, and the results are extraordinary. They're underwhelming in the first few years, but, after doing it for, say, 20 years, you won't believe, the results are almost disbelievable. Okay, Josh's got a 3-bed, 2-bath property in Brisbane, inner north, worth 1.6 with 1.4 million owing, roughly 20,000 in the offset account. Okay, so here's his question. I'm currently worried about ensuring that I'm taking advantage of a long-term investing time horizon I have. Since owning the home, I am confused. Do I invest any fortnightly savings into ETFs or the offset account? I'd love to own an investment property in the future, but I'm unsure if it would take us so long given our high debt to income ratio. I'm currently only 2 years into my career thanks to 7 years at uni, although as a physiotherapist, my earnings aren't spectacular. My wife is currently salary sacrificing 8% into her super. Would it be better off going into the offset? Any thoughts would be greatly appreciated. Josh, firstly, well done. Well done on getting yourself into a fantastic situation. The best investment that you can make is really an investment in yourself. So you've done that 7 years at uni. And I think self-education and, improving yourself is really an investment that will continue to pay dividends for the rest of your life. Well done also on investing. Yes, okay, you made some mistakes earlier on, but you've course corrected and you really are in a fantastic situation, in a much better situation than I think I was when I was 28, 29. Actually, at that stage, I'd started my business, so I was really focused on that. But, in terms of net worth, you're certainly off to the races from that perspective. I think that there's really two elements to this, if I was in your shoes, is firstly, making sure you've got a big enough buffer. So I think the question is, what do I do with surplus cash flow? The first question I would ask in most people's situations is, do they have enough cash? Because if you don't have enough buffer to navigate inevitable unexpected changes in life, that can cause some stress and potentially knee-jerk reactions in terms of making poor long-term investment decisions. So you got 20 grand in the offset, 40,000 in ETFs. I'd probably like to see you have something like 50 or 60,000 in the offset before you started prioritizing investments. So that's what what I think I would do if I was in your situation. I would probably not bother with the extra super contributions that your wife's making. The reality is on your income, family income, and the fact that you've got 30 years worth of contributions to make at 12% of that income, you probably don't need to make any additional contributions, which is not to say that you shouldn't. I'm saying by the time you get to 60, having contributed 12% on your decent family income, very healthy family income, it's likely you're going to have a substantial amount inside super. So I don't think it's a priority at this stage of life, and I'd prefer to see you accumulate more cash in offset account. Let's fast forward to a situation where you've got $50,000 or $60,000 in the offset account. In that situation, I'm going to contradict myself a little bit because I always talk about having a long-term strategy, and a long-term strategy has context. And a long-term strategy tells you, okay, if you do these things over the next 10 years and, those investments perform over the next 20 years, then you'll be in this situation by the time you get to, say, 50, and that situation should allow you to choose to work as much as you want. Having that context is really good because it gives you something to measure decisions against. But when you're young, it can be really challenging because a lot could change. You could start your own practice, you could have a career change, you could start a family, you could move, from where you're currently residing, move interstate or whatever. So much can change. So it can be difficult at times, particularly for young people, to come up with such a long-term strategy. Therefore, in the absence of being able to create a long-term strategy, the best thing to do is just to make good long-term decisions and then have faith that it's going to work out, which I know sounds really wishy-washy, but really, I think reflecting back, that's really the best approach I've used myself and speaking to clients over the last 20 odd years. So in that regard, I wouldn't worry about how you're going to buy an investment property. I wouldn't worry too much about your debt to income ratio. As long as you've got a sleep at night factor, as long as you've got a good cash flow buffer, as I said, in terms of savings, it'll work out in the long run. Like $1.1 million home loan is a lot today. It was extraordinary 20 years ago, and it will be less than average in 20 years' time. Inflation will eat away at the debt, and you're young, so it's really about acquiring as many growth assets as possible rather than debt reduction. So I would say get the buffer, and then we know the best long-term decision is to keep investing in high-quality assets. So you can't do that with leverage at this stage because you've already got more than enough leverage. So you would just use your savings to put into ETFs. That's what I'd probably do in your situation. But I think, as I said, the priority at this stage is get that savings buffer in the offset account, and then probably don't make any additional super contributions, and then focus on ETFs and keep doing that. And then also the other focus should be in terms of increasing your income. As a physiotherapist, physically you might not be able to do it until you're 60, and you might want to think about, things like potentially owning your own practice, or how can you increase your income? And remember, it's not just about earning more income, it's really about having more to invest. And so there's two, obviously, components to that formula: how much you spend and how much you earn. So it's not just about how much you earn, but you're in your late 20s, soon to be, early 30s, but focusing on your income earning capacity kind of makes sense in terms of your focus, and then growth assets after you've had a decent enough cash savings buffer. But thanks, Josh. Thanks for your question. I hope that helps you and similar people in your sort of situation, stage of life. You're right. I tend to get a lot of questions from people sort of a little bit later in life, and it's good to sort of mix it up with some younger listener questions. All the best, Josh. Okay, we're going to change gears now and go completely the other direction. Bob and Sally. Bob is 63 and Sally is 53. They've got 3 properties, 2 investment properties and 1 home. The home's worth 1.8 in a beachside location, a regional suburb beachside. And so 1.8, and they've got a home loan of 780,000. I should say Bob now works part-time, earns about 40,000, has started a transition to retirement pension, which means that Bob's sort of taking some money from super. And then Sally earns 75,000. So, they're sort of transitioning into retirement, and they've got this home loan and 2 investment properties and some super, and they're kind of wondering what to do. So the 2 investment properties are described beachside regional suburb, 900, or pretty close to the beach and pretty close to hospitals. So I don't know if all these 3 properties are in the same location, but that's kind of an unknown. But I'll just sort of highlight that, because if they are, that would concern me a little bit. I'll come back to that. The aggregate value of the investment properties are about 2.9 with about 1.1 worth of debt. So we've got about pre-tax 1.8 million of equity. And then in terms of super, Bob has 450 and Sally has 260. So that's about 700,000 plus the 1.8. You got to make some allowance for capital gains tax, of course, but we're talking north of 2 million of investment assets. So there's a retirement strategy here. It's just about moving some deck chairs and rearranging some things to make sure that that capital is invested in a way that's going to generate decent returns, create some liquidity, reduce policy risk, gearing risk, interest rate sensitivity. And also, we've got to deal with the uncertainty around income and expenses from property, knowing that anyone that invests in property realizes that, you can have maintenance requests that are unpredictable and can have a pretty big impact on cash flow, which at a time you don't really want to have that impact. So Bob and Sally have set out a couple of 4 different options in terms of selling one, keeping one, reducing debt, running down super over the next few years before you go and sell a property, various sort of things. I think the answer is that over the next 5 years, let's just say, because you don't want to run the super down to zero or risk running the super down to zero, because we can only access Bob's super, of course. We can't access Sally's super. But the first observation would be, can we convert Bob's from not transition to retirement, but in full pension phase? Because with a transition to retirement pension, there's no advantages other than accessing the money inside super, but the earnings are still taxed. Whereas if you start a normal pension, then Bob won't pay any tax on his investment earnings inside super, which would be kind of ideal. Now, Bob can start a full pension at 65, or if he resigns from his job, his part-time job, he can go and start a pension and then literally a week later change his mind and go back to work part-time again. Now, if his employer will be open to that sort of arrangement, and he doesn't risk losing the job because he genuinely has to resign, but there's nothing stopping him from changing his mind, even though he started a pension in the meantime. So that would be a bit of a planning idea there to try and just optimize. It's not going to change Bob's life, but, saving some tax on $450,000 of investments is really ideal. And then I think what we really want to do is say we want to get that 1.8 million of equity into super as fast as possible. Well, maybe not as fast as possible, as strategic as possible. So say in 5 years' time, Bob's going to be 68. In 5 years' time, we maybe would have run down most of Bob's super, and Sally will be 58, so getting close to accessing her super. We've got really 1.8 million of equity in an environment where we're paying capital gains tax and, subject to the federal budget, maybe even more capital gains tax. And we've got, an asset that after all expenses and interest isn't really giving us much money, and it's a liquid. So there's really no advantages, except that if we assume the capital growth rate on those assets are going to be really attractive, maybe they are, maybe they're not. The point is that even despite that, there's some negatives with holding those properties. So I think over the next 5 years, the answer is sell both properties. But I guess given your situation and access to super, you've got some flexibility on, how quickly you do that. And I think it doesn't really, in my experience, the main factors to consider is the market. So the type of properties you have, the tenants in those properties, whether you need to make any improvements to those properties, the best time of year to sell those properties, all those sorts of considerations are probably going to determine the strategy rather than saving tax, getting money into super, these sorts of things. Saving tax, so selling when you're both, fully retired, isn't really going to necessarily save a lot of tax. And potentially if you wait to, if it's a great time to sell now, but you think, I don't want to sell now because I'll pay a slightly little bit bit more tax, I'll sell in 2 years' time. The unknown is, what will you sell for in 2 years' time? Will the market deteriorate? Will values come off? And, by being too finicky with trying to save a little bit of tax, you might end up being worse off on an after-tax basis. So I think it's really just about analysing which property has the best growth prospects over the next 5 years. And so you'd keep that property, sell one of the other ones. At least then you're going to reduce debt. And, really the aim here is to reduce your home loan debt as fast as possible, because your home loan is going to cost you 6% after tax, and that's a guaranteed return. So you've got to earn maybe 9 or 10% pre-tax, probably more than that, to compensate you for the risk, to be actually better off than repaying your home loan. So you can see that there's a compelling proposition here, I think, to at least sell one property so that you can reduce your home loan or repay your home loan. Keep the property that you think has the highest probability of performing over the next 5 years from a capital growth perspective, but be of a mind that if your views around future returns were to change, or you might bring forward that sale. But it's really about the market, the type of property, all the things that I just spoke about. When the tenancy agreement expires, these sorts of considerations are probably the key things. Then once you've sold, you want to reduce debt, of course, and then you want to get the money inside super. So by selling one now will allow you to utilize concessional contribution caps as much as possible, hopefully, to get as much of that money into super as possible after reducing your home loan debt. And then by delaying the sale of the second property for maybe 3 to 5 years, will then allow those caps to refresh, particularly if you use the bring forward concessional cap limit, to then sell that final investment property and get all that money inside super. Remembering, of course, the key proviso here is that your money is well invested inside super. So that is, the returns are very competitive and the fees are low as well. Just as a reminder, plan is to prepare a much more detailed report this year. Normally I look at super returns at the end of the financial year, so towards the end of July, early August. I'll do that again, but the plan is to have a more detailed analysis and report. So for those that listen to the podcast regularly and, ask themselves annually, is this the right super fund for me? Because I think that's a good question. That expanded report will hopefully be more useful in doing that analysis. So Bob and Sally, that's my, not advice, of course, information only, but just some commentary around some of the things that I'd consider in your situation. All the best. Okay, next question is from Jose. Jose writes, just finished episode 396, which is the one about the AI trade, about, what can we learn from the dot-com bubble? And the theme in that episode was really that it's really hard to pick who's going to be the winners from AI. Anyway, Jose goes on to write, your analysis of market cycles is always insightful, but I want to offer a counter perspective on the idea that Australia favouring shares over property due to potential CGT changes would be a negative outcome. I actually believe this shift is the exact structural reform Australia needs to ensure its long-term prosperity. For decades, our tax system has incentivised debt asset accumulation. When an investor buys a 4-bedroom house, that capital doesn't fund innovation, R&D or job creation. It simply increases our household debt, which as of 25-26 remains among the highest in the world at over 110% of GDP. We often compare ourselves to nations like Sweden and Denmark, yet they consistently outpace us in economic complexity. Australia currently ranks significantly lower, around 74th globally, because of our wealth is tied up in houses and holes, mining and real estate. Sweden and Denmark have successfully fostered global MNCs, multinational companies, I guess, IKEA, Volvo, and some pharma companies, because their capital is directed towards productive business-like ventures. If removing the CGT discount on property nudges capital towards the share market, aren't we finally incentivising Australians to invest in productive capacity of a nation rather than bidding up the prices of existing rooftops? The physical houses don't disappear, and they either stay as rentals under the new model or become homes for first home buyers. Either way, the dead capital is liberated to fund the Australian multinational corporations of the future. I'd love to hear your thoughts on whether our addiction to residential property is actually the bubble that is holding us back from industrial potential. I feel like I butchered that one. Didn't read it very well. But anyway, Jose, it's a really, really, really excellent question and observation. Yes, I definitely agree in putting capital towards housing certainly doesn't necessarily help us grow the economy, although with a rising and growing population, housing's important. You can't grow our population without housing. But of course, and the thesis behind that is, you grow your population and you bring really smart people to Australia, they're going to grow the economy. But I guess it depends on, who are those immigrants and what sort of screening and, which ones do you select, all these sorts of things. So that's important too. So I think housing's still important, but not as important as investing in the share market. And capital going into Australia and Australian businesses hopefully will do exactly what you say, except there is one really substantial difference between the Australian market and the global market, and that's dividend payout ratios. Maybe it's because we're addicted to imputation credits, and maybe because of our super system and the fact that there's a 15% tax rate for trillions of dollars of retirement savings, and then you've got the share market that's paying out dividends that gives a credit of 30% tax paid. Maybe the design of that system is essentially creating a share market that is addicted to high dividend payout ratios. And that's a problem, right? If you look at globally, dividend payout ratios and dividend yields are much, much lower. And what we really want is our banks to retain all their profit, or a lot of their profit, and reinvest it. Reinvest it by being more productive, by potentially employing more people and growing their own business, by innovating, really. That's what we want, is innovation. But instead, CBA can't do that. CBA has to keep paying out large dividends each year because the market is addicted to it. And if CBA changed its approach, its share price would drop. And if its share price drops, all executives don't earn very much money. So they're addicted. The executives are rewarded on the share price performance, and the executives know they've got to keep paying out these dividends to meet their bonus targets. And I don't think it's really great for shareholders in the long run. I want to invest in a company that is smart, that's well run, that can grow, because the compounding growth inside a business is worth a lot more to me than dividends. If you give me dividends, then I've got to reinvest them. I've got to find somewhere to put that money. So yes, I think, our addiction to property, investing in property and borrowing to invest and so forth does come at a cost of the capital that could flow into the share market. But I think it's deeper than that. I think it's the design of so much money, so much of Australians' money is going already into the share market via super. So we're already doing that, but a lot now is going to go overseas, of course. But I think the biggest problem is that most of our businesses in Australia, the large cap stocks, pay out too much of their profit in dividends and don't innovate, don't reinvest, don't grow, because they're really forced to pay out those high dividends in order for them to achieve their share price targets. And this is not a new thing. I mean, Australia's been doing it for decades in terms of paying out high dividends. And Campbell recorded a podcast a few months ago about the Australian market. Okay, so I found the episode 397, which was really why the 45-55 split doesn't add up in terms of investing in Australian and international shares. That's one of our concerns, is that, more growth is going to come from other developed economies, not only because they represent 98% of, the value of markets, Australia's less than 2%, but also because by their very nature, they're rewarded for reinvesting in their business. And if they do that well, and we don't need to really worry about picking stocks, we just invest in index, that will get more growth, and more growth is better over time than income. So Jose, great question, and thanks for submitting it. I like your way of thinking. I think it's correct to an extent, but I think the dividend payout ratios in Australia is the thing that's unfortunately our biggest Achilles heel. And it's a real shame, because I think we've got, a really good culture of innovation, and, we could be doing so much better, I think. Okay, next question is from Mark. Mark says he's been following the typical life cycle of investor since I started writing about the concept. So I think I wrote a blog, well, he's referencing, I wrote a blog in July 17 about it. And then I did another episode a few years ago, episode 253, which is also just an updated view of the life cycle of investor, and also listened to How Much to Invest in Property Shares and Super that I recorded in November 22. He said, how do I apply this to my situation? In step 2, you say in your 30s and 40s, your focus is to upgrade your home and invest in property. And then step 3 in late 40s and 50s is to tilt towards superannuation and shares. My wife and I are 44 and 42, and we've done well with the resources we have. My salary is 150, wife is 80. Got 3 kids in private schools, year 10, year 7, year 2. Upgraded home is worth 1.8 with no debt, 3 investment properties with aggregate value of 2.6 with 1.5 mil of debt all around Brisbane. They've done well recently. Combined super 480, 50% in shares and 50% in cash. Why cash, Mark? You might want to have a look at that. $80,000 buffer, no ETFs, only holding costs are about $20,000 a year. Mortgage broker says I can borrow another $750. So his question is, how do I apply the typical life cycle of investor? Step 2 says keep investing in property in your 40s. However, I wonder if this is wise given the high exposure to property and debt and nothing in shares. I'm wondering if you have a view on this. Well, my view is that I probably need to record that podcast, re-record that episode, maybe update it or so. But look, I think that those episodes, and just for the people that haven't listened to it or read those blogs, it's really my aim was to say, look, there's typically people go through different stages, life stages, if you like, and they tend to rhyme, although people's situations are very different in terms of what's important to do at what stage of life. That's what I was trying to get across. And it's really about sort of build out property exposure first. And once you've built out that property exposure, then start tilting towards shares and superannuation, which I've been talking more about, I think, over the last couple of years than I have previously. And I guess it shows, and that's why I wrote Wealth by Design. Just a little plug in here for those that want to pre-order. Link is in the show notes. But that's why I wrote Wealth by Design, because it's been 8 years since I wrote Investopoly. So much has evolved. I think the core, in terms of the core ideas behind it, still remain intact, but the nuance and the approach and the implementation has changed a lot over that 8 years. I think hopefully in 8 years' time, I'm further advanced again. So, and this is one of these things. So I don't think you can take it literally to say in your 30s and 40s, you invest in property and don't invest anything else. And as soon as I turn 50, I'm going to pivot and do something else. It's really about build out your property exposure first. Then once you've done that, tilt towards investing in shares and superannuation. So if I come back to Mark's situation, no home loan debt, sounds like they've got their forever home, 3 investment properties, with more than $1 million of equity in them. That's enough. You've got 3 assets. They're working. You hold those 3 assets. They're probably going to do most of the heavy lifting. It's now time. You've got enough assets. You've got enough assets inside property, I should say. It's now start introducing other asset classes outside of super, I think, because you're 44 and 42. So you're probably, given your asset base, you're probably going to get yourself into a situation where you could have the flexibility to either reduce working hours or retire in full before age 60. And so what I would be doing is building a pool of liquid growth assets outside of super to give yourself the potential ability to do that in 10 or 12 years' time. And so that's really investing in ETFs, still investing in super, of course, making super contributions. So you might want to do a little bit of both, or probably maybe 70% outside super and 30% of your surplus cash flow inside super, something like that. Not advice, just information only, of course. But the big thing is, I don't know why you've got 50% of your super invested in cash. If you've got a time horizon of 15 to 20 years, which you do, it should be in growth assets, Mark. Oh, I should have read the full email before I answered. My apologies. Because question 2 is, you may have noticed that I've got 50% cash inside superannuation. Morningstar produced a chart of $10,000 invested from 1993. That's really when super started, by the way, 92, 93, through to 2023, 30 years worth of returns, and compared returns to CPI, cash, Australian bonds, listed properties, international shares, etc. I've got a very similar chart. I note that if you invest invested in US shares in 2000, it took until 2014 for the original investment to recover to the same value. If invested in Australian shares in 2007, it took until 2013 for the original investment to recover the same value. After the GFC crash in 2020, well, the GFC crash was '08, but I think Mark means the COVID crash. COVID crash in 2020, I was fully invested and rode the recovery. I have made no purchases since, with all the superannuation contributions and dividends going straight into cash, with the intention to buy the next major dip, which we all know will eventually come. Just we don't know when it will happen. Can you please give some commentary to this investment strategy rather than being always 100% invested and dollar cost averaging over several decades? Okay, Mark. Well, refer to episode 403 that I recorded in 26 April this year, where there's overwhelming evidence that suggests that if you're waiting for the market to dip, yes, it could be theoretically, not even theoretically actually, I can understand the logic around the strategy, except all the data says that you're most likely to be wrong, because what are you missing out on in the meantime? And we only have to look at, we had a bit of volatility obviously this year. When was it? March, April, May, sort of around that time? No, it would have been March. Most of the volatility, thanks to Mr. Trump, February, March, maybe. But, we were still up on a 12-month basis. So the thing is that what are you foregoing in terms of opportunity cost by being in cash? And all the evidence suggests that that opportunity cost is way too high, that you're much, much better off to be fully invested. And the longer the time horizon you look at, the more compelling the data is. So your only goal with super is really to maximize average returns between now and age 60, or even a little bit beyond age 60. We use 60 as kind of the deadline because that's when we want to access super, but you've got a lot of property assets, so you don't necessarily need to access super at 60. So you could say you've got a 20-year time horizon, therefore, and you can't access super anyway, right? So you're really forced into a 20-year time horizon. In that situation, all the data says remain fully invested. But look, the overlay on top of that is that how you invest the money is equally just as important, I think. If you look at the US share market and you look at the GFC, you look at the COVID correction, you look at the Aussie market, if you have a value-aware asset allocation, you're most likely to navigate or, avoid some of the pitfalls of these charts, because these charts are done on just traditional market cap indexing, just, traditional indexes, if you like. So yes, if you blindly invest in the index today, a lot of your money is going into the US, a lot of your money is going into the top 10 stocks in the US. Some of those stocks aren't valued attractively, and so there's a bit of risk in that index at this stage. But if you're fully invested and you're adopting a different approach to try and navigate some of those risks, then, arguably, based on that data, you're most likely going to be better off doing that. So how do you do that as an investor? Well, I would steer clear of the index options inside super funds because they tend to be almost exclusively traditional market cap indexing, which is okay, but, it doesn't really help you reduce the risks. Okay from a historical perspective, it doesn't help you reduce today's risks. So by investing in a sort of traditional actively managed growth option rather than a fully indexed option, I think at least then the super fund's going to be thinking about some of those risks that I just spoke about in terms of concentration and valuation. And that's probably really the best way to kind of navigate that. Okay, I think I'll leave it there for questions. I do have a lot of questions to get through. I noticed that I'm just finishing off February and getting to the March questions, so I'm still a couple of months behind. But look, keep them coming in because I still like to have plenty of content. We might just have to do, maybe some extra episodes or something like that. Anyway, tomorrow I'm going to talk about investing all of your super into an internally geared ETF. So I got this question from a listener on YouTube about that. And, there's some diversified ETFs that have some internal gearing, about sort of 30, 35, well, let's call it 30 to 40% of internal gearing. And so if you're in your 30s, for instance, how does that work out? Noting there's some risk there, all traditional market cap indexing. Anyway, it's an interesting episode because I did the numbers. So I'm going to talk about that tomorrow. Just as a reminder, I'm sorry to keep belting you over the head with this, but if you are of a mind to buy my new book, Wealth by Design, the pre-order link is in the show notes, and it would be of a great help to me, notwithstanding you'll get the bonus, but the pre-order bonus would be great help to me if you pre-ordered it. And I'll leave it there until tomorrow. Bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.